My name is Michael Christian. I'm a lead advisor here at EverPar Advisors, and joining me today is our Director of Investments, David Ellis. Welcome, David.
Thank you, Michael. Good to be here.
So today's topic is going to be private credit, and all things private credit is what we're going to discuss. We're seeing it a lot in the headlines, and we wanted to take this opportunity to just dive into more details about what is private credit, how is it used, what are the items or things that clients should think about when incorporating it into their portfolios. And so just diving in here, can you explain, David, what exactly is private credit?
So I'll take this from a high level, Mike, but one really easy way to think of this is everybody thinks of credit in the terms of coming from banks, and it'll be loans. It could be, a million different ways that they're distributing out money to the public, to companies, to whatever via a loan. Private credit is essentially a private lender stepping in and making that loan instead of the bank. This really got some momentum after the global financial crisis. We had new regulations, new legislation that required the banks to treat their loans a little bit different. And they had to store capital on their balance sheet for the loans that they were putting out. And essentially, they stepped away from that space for a while. Someone had to come in and fill that void. And that is where the private credit managers have really stepped in and got to be well known to the general public. Obviously, this goes back prior to the global financial crisis, but it's really gained its momentum since then.
That's helpful. Thank you, David. And you said that it is a private lender, so not a bank stepping in to make a loan. What exactly are they loaning to? That's a pretty general term. Can you describe that a little bit more?
Definitely. So one great example it is if you have a mid-size company, and really private credit goes to mid-size, it goes into the large cap and the ultra large cap. So it's not just one size of company, but any company that needs funding may want to avoid dealing with a bank. When they do that, there's going to be a ton more paperwork. It takes longer to get the loans approved. The process of going through a loan where they can go to a private credit lender. It's a lot faster. They can get their money quicker. They will pay more for that, and they're willing to do that, pay a higher interest rate to move the process along quicker. It also allows them to avoid having to file a lot of regulatory documents if they're borrowing from a bank. So there's a multitude of reasons why these companies would look at private lending, even though it's more expensive. But it does have the advantages that the companies find attractive to push them to that space rather than going to a bank, if the bank would even loan to them in the first place.
So we have a company, an organization stepping in to act as a lender, normally filled by a bank. They're no longer doing that, so this lender is stepping in. It sounds like they're making a loan to a private company. Now, as you in your investment chair are looking at the opportunity set out there in private credit, how do you evaluate the opportunities of the managers, and what are you looking for?
When we're looking at the managers, we look for experience in the industry. How long have they been doing it? Have they worked through multiple cycles where there's been stress in the fixed income markets or the bond markets or the loan markets? How did they work through that stressful period? Were they able to rework some of these loans if they had to in that space to make it, continue to not default and be in good order? Other things we look at in here is when we're looking at a manager, how good are they at underwriting these loans? That's one of the key pieces that we want to know inside of here is what is their underwriting process? Are they going really in depth with these companies? What we're finding is typically it's a little bit more in depth than what the banks do. The covenants in there can be a little bit tighter, and so that protects the investor and the company that's lending the money. So we're looking through all of these ways that they're lending, their experience and how they lend, and the structure of the loans when we're deciding if a manager makes sense for us or not.
Okay, that's helpful. So you've decided, that you have a manager that you'd like to invest on behalf of clients. So as a client investing in this space, what are some expectations that I should have about the advantages? What should I experience in the portfolio? Can you just kind of tell me about what the experience is investing in private credit?
So the question we get a lot is, why would I invest in private credit when I can just go buy public credit? There's some big differences in between the two. Public credit typically is going to be liquid to you. You can get your money back from investments there within a couple of days. In private credit, it's not as liquid. You're typically going to have quarterly options for liquidity in these funds. Typically, those funds will deliver out or give money back on a quarterly basis equal to about 5% of the value of the fund. And so there is the chance that if more people are wanting to take money out that quarter, that if that amount is higher than the 5%, you may not get all your money back in one quarter. It may take multiple quarters to get that. So that's one major difference between the two asset classes. So then the next question is, well, if I can't get to my money as quick, why would I look at that space? We like that space because as you look at it historically, you're getting returns that are about 2% to 3% higher than what you get from the public markets. Most of that is due, obviously, to the liquidity risk that you're taking on. The yield on those is higher as well. So you could look at it from a yield or a total return perspective. Right now, I would say the yields that you can expect to see in private credit in this time frame in 2026, you're probably looking somewhere around 9%. Last year, they were paying around 10%. Obviously, rates came down a little bit. If we see rates reduce to a level that we've seen in the past, very low, getting into that 2% or lower phase, we still think the bottom line for these private credit funds is going to be somewhere of a yield of around 7%, which at that time for fixed income, public fixed income, you're not going to find yields that way. So it is an enhancer of yield, an enhancer of total return. And so that is the reason that we look at that for our clients, because some of them need that higher income level, and it allows us to deploy their assets in a manner that gets them the income they need, and then what's left over, we can invest in growth for them.
Okay, so what I heard you say, David, is that perhaps there's some more stringent lending requirements there. I potentially getting them a higher yield by investing in private credit, but ultimately the trade-off I'm making is that it is less liquid. I can't sell it on a daily basis, but I'm being compensated for that illiquidity by generating higher income. Is that correct?
That's correct. You got it.
So if that's a good fit, as again, from a client standpoint, when would private credit not be a good fit for my portfolio?
Someone who's needing access to those funds in a relatively shorter period of time, and I'll kind of couch that around, maybe within 1.5 to 2 years, if you need those funds, I would not be investing in the private credit space. A lot of those funds may have a 1-year lock where you're required to stay in there for 1 year. And then if you do come out early, there's a penalty associated with that. So anybody that would need this money in the next 18-ish months plus, or 18 less, we would obviously not recommend that for someone. Other people that need to see the value of their fund and an updated value on a daily basis would not appreciate how this fund is marked. So when you're seeing your results on these funds, they price the fund once a month. So you're not getting daily pricing inside of there. We're comfortable with that as we work through the loans and talk with the different managers. We're comfortable with getting them priced once a month. But if someone has, an issue with that, they would not be a good choice to invest in the private credit space.
And you mentioned this, or you may have mentioned this earlier, and I just missed it, but what is the tax treatment of this kind of income? Is there any tax benefits, or can you explain that a little bit?
There is no tax benefit per se from this. This is going to be treated just like interest income, which would be, ordinary income is what you're going to be taxed at as these come out. Typically, these funds pay you on a monthly basis. Some of them may pay on a quarterly basis. For the clients that don't necessarily, they need the stability of private credit, which is similar to clients needing stability from public bonds versus public equity. On the private credit side, if they're just looking for stability in the income for total return, we'll move those assets and purchase them in IRAs, which will shield the client from having to pay the ordinary income that comes off of those. So it's really client by client where we would put that investment inside of their portfolio. But as far as tax treatment, it's not tax efficient. And so when you're getting that yield in a taxable account, it'll come through on a 1099 as interest or ordinary income is essentially how it's taxed.
And last, I'd be remiss to not ask about private credit in the headlines. I've seen some articles pertaining to private credit. Can you talk a little bit about just kind of what's going on in the private credit space currently?
What we're seeing in private credit right now is I think the initial kind of bolt a couple of months ago was when one of the AI models came out with a tool inside of it. It allows them to code. You can code quickly where the AI tool's coding for you. And the concern came the number of loans in private credit that are made to software companies. Software companies were always viewed as a very good loan prospect for these private credit lenders because they have income that comes in on a monthly basis. A lot of the stuff is subscription models to them. And so that when they have that cash flow and it's certain to them, or they can see that, they liked that style of underwriting companies in that way. So that was a space they really wanted to look at and invest in. So you would see in portfolios somewhere in between 15 to 20% of these software companies in there, and everybody came concerned that the AI models were going to basically cause these companies to be obsolete. We don't see it that way. There's lots of companies that the AI will actually sit inside of the software and make it more effective for the companies. From a private credit standpoint, their main concern is that this company stays at, as a going concern and doesn't file bankruptcy. So there's a lot of leeway before this AI issue can really affect some of these software companies. Everybody worried about that. And that created some panic. Some people came to withdraw money from the private credit, and they were asking for withdrawals that are above and beyond the 5% level that we had talked about earlier. And when they do that, ultimately 5% goes out. So if you were requesting a higher level than that, you got prorated out, and you'll have to go back next quarter to request the rest of that. Now, when the media was going through all of this, there was obviously the software component that I think they made it seem like it was going to be a lot more negative immediately to these firms. And we're not seeing that through the growth of the firms that these loans have been made to. We're still seeing growth in revenue. We're not seeing the issues from the AI in those companies yet. I think one thing that gives us even more comfort in this is that there was a large private credit lender that recently sold a portion of their entire portfolio, about $1.5 billion they sold. When they did that, they sold it to 3 or 4 different large institutions, pension funds here in the United States or in North America. These pension funds are thought of as some of the more sophisticated investors that are out there. They bought these loans at 99.7 cents on the dollar. So basically, they bought them at cost, at par. And ultimately, what that says is they believe that these private credit lenders have done the proper underwriting, that the news cycle that we're hearing isn't really affecting these companies, and they don't see it affecting them before these loans will mature. So we think a lot of it is just headline risk, that the narrative from the media maybe isn't dead on, and they don't have the facts exactly as what's really going on in the space.
That's helpful to know. Thank you, David.
No problem. Thank you, Mike.